My name is Guido Ravoet and I am the Chief Executive of the European Banking Federation. At the end of January, the European Commission published a proposal to separate activities of major banks in Europe. The criteria that the Commission foresees would force a breakup of about 30 of the biggest banks. The European banking sector is very concerned over this proposal. We believe that structural reform is actually a serious risk to the economy. There are better solutions available. We strongly support the universal banking model. This model has proven its value when it comes to financing the economy and ensuring financial stability. The Commission incorrectly assumes that banks that only take deposits and grant credits have a so-called normal business exposure and are therefore safe. Well, history has proven that this is not true. Most crises are indeed related to housing issues, and financing small and medium-sized companies is also very risky for a bank. So the so-called narrow banks, which mainly deal with housing and SME financing, are no safer than universal banks. The proposal on structural reform also is premature. It leads to too many uncertainties and it requires a thorough supervisory assessment. Rushing things could also mean that financial activities shift to the shadow banking system, much less regulated and more risky. Another risk of this proposal is renewed fragmentation of the single market. Many reforms are being put into place in the banking sector already. To name just a few: proper bail-in tools, recovery and resolution planning, capital buffers for systemic banks. So resorting to bailouts will no longer be necessary in the future. And these ongoing reforms do not harm the ability of universal banks to transform and channel capital flows to where they are most needed in the economy. But structural reform has exactly the reverse effect and should remain the tool of last resort. We urge all policymakers to keep this in mind. Thank you for listening.